Your statement says the fee was $5,000. 1% of 500,000. It is a real number. It is printed right there, and it is not the number that matters. The number that matters is $452,758, and it does not appear on any statement you will ever receive. I am Susan, and today we are going to run the whole thing. One portfolio, one fee, 25 years. I'm going to show you where that $452,000 comes from, why it is almost twice what you actually pay out, what the same portfolio looks like at 0.25% instead, and then I am going to make the honest case for the other side, because there is one, and I am not going to hide it from you. Let me set the table. $500,000, 25 years, a growth rate of 6% a year before any fee comes out. I am picking 6 because it is a plain, unexciting long-run number for a balanced portfolio, and because round numbers let you see the mechanism instead of arguing with my assumptions. Swap in your own rate afterward. The shape of what happens does not change. Run it with no fee at all. 500,000 growing at 6% for 25 years ends at $2,145,935. Now run the same portfolio with a 1% annual fee coming off the top. 6% minus 1% leaves 5% to compound. 500,000 at 5% for 25 years ends at $1,693,177. The difference between those two endings is $452,758. Say that against the starting balance for a second. You began with 500,000. The fee, over 25 years, cost you almost as much as you started with. It ate 21% of the ending balance. 1/5 of the whole thing. Now here is the part that surprises almost everyone, and it is the reason I made this episode. Add up every dollar you actually handed over in fees across those 25 years. 1% of the balance in year 1, 1% of the slightly larger balance in year 2, and so on all the way down. It comes to $236,671. So you paid $236,000. And you ended up $452,000 poorer. Where did the other $216,000 go? Nobody took it. It never existed. That is the growth the fee money never got to do. Every dollar that leaves the account in March is a dollar that is not there in April, or the year after that, or 20 years after that. You do not just lose the fee. You lose everything the fee would have earned, and then everything that would have earned, all the way to the end. That is the whole mechanism. A fee is not a price. A fee is a piece of the compounding removed. Let me slow that down with 1 year, because the year-by-year picture is what makes it click. In year 1, the fee on 500,000 is $5,000. That is the number on your statement, and it looks manageable. But by year 25, the balance has grown, and 1% of a bigger balance is a bigger fee. In that final year, the fee comes to about $16,700. Same 1%. 3 times the money. That is the quiet thing about a percentage fee. It is indexed to your success. The better your portfolio does, the more you pay, in dollars, for the same service. Nobody sends you a notice when it happens because nothing changed. The percentage held perfectly still. And notice how the money leaves. It is not an invoice. You do not write a check. You do not approve anything, and there is no month where you sit down and decide whether this year was worth it. It comes out of the account, quietly, usually quarterly, before you ever see the balance. Every other large recurring cost in your life announces itself. This one is the only one designed not to. I am not saying that to be dark about it. It is a normal industry practice, and it exists for sensible administrative reasons. I am saying it because a cost you never consciously approve is a cost you never review. And 25 years of never reviewing is exactly how you arrive at $452,000 without a single moment where anyone did anything wrong. I want to show you the same thing from the other direction. because this is where the decision actually lives. Nobody's real choice is 1% against 0. Nobody manages money for free. The real choice, for most people, is roughly 1% against roughly 1/4%. 1/4% is about what a plain index portfolio costs you to hold, whether you build it yourself or a low-cost platform builds it for you. So, run the third version. 6% minus 1/4% leaves 5.75%. 500,000 at 5.75% for 25 years ends at $2,022,923. Line the 3 up. No fee at all, $2,146,000. 1/4%, $2,023,000. 1%, $1,693,000. The gap between the 1/4% version and the 1% version is $329,746. That is the real question, stated properly. Not is a 1% fee bad. The question is whether what you get for the extra 0.75% is worth $330,000 over 25 years on a $500,000 portfolio. And now, I owe you the other side, because the honest answer is that sometimes it is. Vanguard has published research on this for years under the name Advisors Alpha. They broke down what an advisor actually does into 7 pieces: choosing a sensible asset allocation, implementing it cheaply, rebalancing, behavioral coaching, putting the right assets in the right kind of account, choosing a withdrawal order in retirement, and total return investing rather than chasing income. Their estimate is that following that framework can add about 3% in net returns over time. And read the fine print with me, because the fine print is the interesting part. That 3% is net, meaning it is after a typical 1% fee has already been taken out. And Vanguard says plainly that it will not arrive as 3% every year. It is irregular. It shows up in lumps, and the size of it depends enormously on the individual. Look at that list of 7 again and notice something. Only 2 or 3 of those are about investments at all. The single biggest one, in most estimates, is behavioral coaching. That is the polite name for the phone call in March of a bad year, the one where somebody talks you out of selling everything at the bottom. If that phone call happens once in 25 years and it stops you from going to cash after a 40% drop, 1% was the bargain of your life. If that phone call never happens, because you would never have sold anyway, then you paid $330,000 for a quarterly statement and a Christmas card. Both of those households exist. I have described both of them to you. The uncomfortable part is that you have to decide which one you are, and nobody can decide it for you. So here are the 3 questions I would ask, and I would ask them out loud, of a person, and I would want the answers in writing. Question 1. What is the all-in number? Not the advisory fee. The all-in number. That means the advisory fee plus the expense ratios of every fund inside the account, plus any platform or custodian fee, plus trading costs. It is very common for someone to be told they pay 1% and to actually be paying 1.4 or 1.5 once the funds inside are counted. Ask for it as 1% and as $1 figure for last year. If the answer takes more than 1 email to produce, that is itself information. Question 2. Which of the 7 are you actually doing for me? Read the list back. Am I getting a written withdrawal order for retirement? Am I getting tax-aware placement across my accounts? Am I getting rebalancing on a rule rather than on a mood? Am I getting a plan I can hold in my hand? A good advisor will be pleased you asked, because a good advisor is doing most of them and rarely gets credit. If the honest answer is that you are getting funds picked and nothing else, you are paying a planning price for a fund picking service. And while you are asking, ask what happens to the percentage as the balance grows. Many firms have what they call breakpoints, where the rate steps down above certain balances. 1% on the first 500,000, then something lower above that. If your account has crossed a line and the rate never moved, that is a conversation worth having, and it is a conversation people almost never start because the fee never sends a reminder that it is time. Question 3. What happens on the worst day? Ask, in plain words, what you will do for me in March of the year. The market falls 30%. If the answer is a real answer about a real process, that is the behavioral coaching module, and it is worth money. If the answer is vague reassurance, notice that you are paying most of your fee for the piece least likely to be delivered. Now let me run the case, because this is the retirement lab and we finish with a household. 2 couples, both 60. Both with $500,000. Both earning 6% before costs. 25 years ahead of them. The first couple pays 1% to an advisor who does all 7 things: written plan, tax-aware placement, rules-based rebalancing, and a real phone call in every bad year. They end at $1,693,000. The second couple holds a plain index portfolio at 0.25% and never panics, not once, not in any of the 4 bad years they lived through. They end at $2,023,000. The second couple is $330,000 ahead. But change one detail. Say the second couple sells out at the bottom of 1 bad year and sits in cash for 18 months before coming back. One event, once, in 25 years. Depending on which 18 months, that single decision can cost more than the entire fee difference. That is not a scare number I invented, it is arithmetic. Missing the sharpest part of a recovery is expensive in a way that is hard to feel until you model it. So the second couple is only ahead if the second couple is genuinely the kind of household that does not sell. Most people believe they are that household. Fewer people turn out to be. There is a third couple, and honestly, this is the one I meet most often. They pay 1%. They have never had a written plan. They have never been asked what order they intend to draw their accounts down in. In the bad year, nobody called them, and they wrote it out on their own nerve because they did not know what else to do. Their money is invested perfectly sensibly in a set of funds anyone could have chosen. That household ends at $1,693,000, exactly like the first couple, because the arithmetic does not care why you paid. They paid the full price for the full service and received about 1/4 of it. And this is why I keep pushing you toward the 3 questions instead of toward a verdict. I cannot tell you whether 1% is too much. Nobody on the internet can, including the people who say it very loudly in both directions. What I can tell you is that couple 1 and couple 3 paid the identical $330,000 and got very different lives for it, and the only thing separating them was whether anybody ever checked. Here is where I land, and then I will let you go. The fee is not the villain. The unexamined fee is. $452,000 is what a 1% fee costs on $500,000 over 25 years, and you should know that number because it is the price tag on a service you may or may not be receiving. If you are getting all 7 pieces and a human being who has talked you off the ledge, that is a fair trade and I would not touch it. If you have never had a conversation about withdrawal order, never seen a written plan, and cannot say what your all-in cost was last year, then you are not deciding. You are defaulting. And on a $500,000 portfolio, defaulting for 25 years has a number, and I have just shown it to you. Run the same 3 lines on your own balance tonight. Your number, your growth rate, your years left. It takes 4 minutes with any compound interest calculator, and once you have seen your own 3 numbers side by side, you will never look at that little line on the statement the same way again. One thing to say clearly before I go. I am not a licensed financial advisor, an attorney, or an accountant. This is general information and a worked example, not personal advice about your situation. The figures here are illustrative. The 6% is an assumption and not a promise, and rates of return are debated for good reason. Anything tax-related you should confirm for your own year with the Internal Revenue Service. Tell me in the comments what your all-in number turned out to be, and whether you had to ask twice to get it. I read those. Run your numbers. Know you're on track.